By that point, Diageo might have recovered. Who knows? Seems unlikely, but it's up 11% this week, so there's signs of progress here, and that's partly the result of their report for the full year. Bear in mind they've had a change of CEO recently, which we'll come to in a moment, and they're kind of between their previous CEO and their new permanent one, which hasn't been announced as I understand it. But generally speaking, these results were ahead of analyst expectations. Organic sales were up 1.7%. Didn't actually write down what they were, but they were up 1.7%. And it's rates of change, I think, that move stocks, at least in the short term. Earnings per share were down 0.7% due to an increased investment in facilities. So you had higher costs, basically, but investment costs rather than production costs, I guess you might call them. The dividend was unchanged from the year before, which I suppose wasn't a massive surprise, but that's where we are at the moment. The guidance was much more positive for 2026. It's similar in terms of sales, so another kind of 1.7% organic growth. But they're looking to make some big cost reductions, which we can get to momentarily. And they're expecting that to drive profits higher by about 5%, which is, I guess, better than people were expecting at that point. It feels to me like a little bit of people seem to be thinking a decline was kind of on the way. I've been hearing and seeing stories of potentially terminal decline with GLP-1s and shifting consumer preferences and younger people drinking less. And I know that's a topic close to your heart, Steve. But what we kind of seeing at the moment is I don't think this is a stock priced like a terminal decline stock by any means. It's not trading with a British American Tobacco dividend yield or anything like that. So I thought it was kind of priced about right. That set of results there gets you sort of an immediate 10% lift, and it works its way to 11% higher by the end of the week. That feels like quite a lot, and it is quite a lot, to be honest. Up 10% or 11% is the biggest thing I managed in my portfolio this week. But it's still 22% down year to date. So, I mean, to some extent, the market hasn't just written off all the challenges for a moment and acted like they've gone away. We're still well behind where we would have been if we bought the stock in January. A couple more 10% uplifts, though, and I will be back to where I started, no doubt on this. It feels like a long time ago, but it wasn't. It's not so long ago that we were looking at Diageo, and their guidance was for medium-term 5 to 6% organic revenue growth per year, which is, you think, maybe 2% inflation, and then plus a bit more in terms of pricing and volumes and so on and so forth, and that's where you get to. And that feels like a long way off with sort of 1.7% the target for 2026. And okay, profit numbers are going to get to there, but that was supposed to be sales numbers, and then you can work out your margins from that point. I think cost cutting might be a good thing here. If you can take unnecessary costs out of the business, sure. That's only the kind of thing you can do so much until you start cutting out either things that matter or run out of scope to widen your margins by taking out costs. And I sort of wonder in these cases where people think we're going to start reducing costs exactly what we were doing, carting around so many unnecessary costs in the first place. But in some cases, these are kind of justifiable, and in some cases, failed experiments, in some cases, just a change in trading environment and so on. But cost cutting seems useful. It does feel very the move of an interim CEO who was once the CFO, to my mind. And that's part of my objection to getting carried away with this. So Nick Changiani is in charge for the time being. He was the CFO and he's become the CEO and immediately started saying, in my head anyway, let's try and cut some costs somewhere because I'm a finance guy. And whatever you thought of Deborah Crew, and I did not have a terribly positive view on her, but in her interview with Nikolai Tangen in the In Good Company podcast that you were telling me about, Steve, I thought she did a pretty good job of talking about Diageo and its growth opportunities and the things they were focusing on. So she talked about opportunities to market their products as accompaniments to food in the ready-to-drink space, a kind of trend towards premiumization, zebra striping in terms of 0% drinks, and so on and so forth. Believe them or don't believe them for the time being, but this is talk of potential growth opportunities. This is what we think we can do in terms of growing. CFO comes in, there wasn't much of a mention of this stuff, and it was more a kind of, although there is growth in the zero space for stuff like Guinness Zero, it's more seems to now be focused on where can we cut some costs to widen the margins a bit because we can't make sales go much higher than they currently are. The thing I found with Deborah Crew was I found her very unconvincing about her own interest in her own products. She felt like the guy in charge of, I think it's Philip Morris, who doesn't smoke, or Imperial Brands, or one of the cigarette companies, is run by a non-smoker. I imagine you're going to tell me which one here, Steve, because you mentioned it to me before and told me that.
Bats, isn't it? He has a name like
Bats.
Smokey McSmokerson, but he didn't smoke, if I remember.
Someone like that. Some Smoky Joe somewhere in charge of one of the big cigarette companies doesn't smoke. And I sort of got the impression that Deborah Crew sounded a bit like that, talking about some, but not all of her products anyway. But anyway, stock, that puts the stock at a PE ratio of 16 when I looked, and it puts me in a kind of awkward place, really. I like it less than I did before at this valuation. I didn't see this as 10% higher particularly. The thing is clearly not internal decline, but I never really believed that we were. Steve, what do you think?
The one bit that I picked out that was quite interesting was that they were blaming the Moet Hennessy for the lower EPS. That was one of the factors. They had a lower contribution than they expected, and that's why it was lower. But yeah, that felt to me like a little bit of passing the buck a little bit. But yes, I was reading a study in the middle of the week, Steve, that really jumped out to me. So Gen Z are now getting to working age. Some of them have done a couple of years of in employment. And this was the age group that everybody talks about, which is the ones that aren't drinking. Essentially, this is going to be the first generation that comes through that drinks a lot less than the generation of their parents. And yes, like I say, these people have done a couple of years at work, and they are now drinking in a reasonable amount. So it was much less than half of them were drinking at this point last year. They've obviously done another year of work, and now nearly over 3/4 of them are regularly drinking. And the good news for people like Diageo is that they're actually avoiding things like beers. They're actually starting with spirits and mixer-based spirits as well. So that should benefit Diageo quite a lot. They're far more likely to drink in bars and restaurants and nightclubs than at home, which is good news for the likes of Spoons and people, Steve. But it's been these are obviously US figures, sorry, but if you look at the actual world figures as well, that's crept up as well from around 52% of them drinking to around 66% of them have had a drink in the last year, an alcoholic drink in the last year. So that trend about them not drinking is essentially nonsense now, Steve. I think we can put that one to bed, and I think that's pretty positive for Diageo, who themselves have parroted this phrase as well. So they've been part of the people who've passed on this story about them not drinking, and it turns out it's maybe not quite as true as they think. On the question, they were asked to agree or disagree with a statement. I am actively choosing to drink more, and Gen Zers out of all the age groups were the most likely demographic to answer in the affirmative. It was a pretty interesting report, really, when you go through it to sort of dispel that rumor. I think what we might see is that they're more prone to, this is the end of the report. The conclusion was that they're essentially more prone to moderation than us, and than the older generations. They're also more aware of how unhealthy it is than the older generations, which again may lean itself to moderation. But it's definitely on the increase, Steve, which can only be good news for Diageo, and I assume they'll stop talking about it soon.
Probably. We'll see. It doesn't surprise me to learn that that's the case in terms of spending patterns and how much Gen Z is busy spending on alcohol now that it kind of can and has entered the workforce as a cohort. I mean, I was hearing a while back, as I was saying to you beforehand, in the context of Weatherspoons, there's actually significant data to say Gen Z and to some extent millennials and younger generation generally saying they don't drink as much and their spending patterns don't really bear that out. They kind of imagine they don't, or maybe want to tell you they don't, or whatever. They do, put simply. So or at least they're spending as much on it as they ever have, or any cohort kind of has before. So it doesn't massively surprise me that they also seem it seems like we are quite a spendy kind of younger cohort, right? I mean, we don't shy away from things like Netflix subscriptions, and partly driven by the thought that no one's ever going to be able to buy a house anyway. So what's the point in saving for one? Might as well go and enjoy your time without one, and do things like drink an edge towards more moderation. If you're going to moderate more, you can spend higher stuff. And Diageo has been very loudly attempting to position itself towards premium stuff, and Guinness.
In my head, Steve, it's them just basically doing what we did, which is just drowning out the realities of life with 10 to 12 cool beers. But on a serious note, what I did take out of it was sort of the key stat that they was throwing in your face, and it was coming. This was a study across, I think it was 16 or 18 nations, but the same stat kept coming up over and over again, was that ready to drink is essentially one of the areas that's going to do really, really well. And what they mean by that are those like weird tins with like mojitos in them and things like that. So they're ready. I would call it a ready mix, but they call it ready to drink. They are one of the things that this generation is picking up in good speed. So I mean, if you can find a stock that has a good amount of them, Diageo is one of them, and that trend obviously continues. Then that could be something good. Who knows though? This is obviously a rapidly evolving story, and we'll have to see what exactly happens next, Steve.
I think AG Bar is another one, actually. They own Funkin' Cocktails now, which is, I think, in that sort of ready-to-drink space. But I've realised I've got LVMH, which is partly overlap with Diageo anyway, because it's sort of joint venture stuff there, alcohol arm, and Diageo and Wetherspoon. It feels like I'm basically just betting on British people drinking more and wanting it cheaper or more expensive. I think that's the worst thing to be betting on for the long term. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.